Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is Jason Hartman, your host, and this is episode number 241. So today, we are going to do this show in like 3 parts here. The first part will be my little discussion here with you about a couple of quick announcements, and then we will have Bob on the show, and we're going to talk about some incredible financing. If you're a foreign national, if you're an IRA buyer who's buying within a self-directed IRA, or if you are above the 10-property Fannie Mae loan limit, you are going to absolutely love this. Or if you just want to purchase in the Dallas metro area, if you're looking at Dallas-Fort Worth as your market, you're going to love what is coming in part 2 of this show. And then there'll be a third part where we have some clips from Meet the Masters. And you have got to join us for our Meet the Masters event. We're lining up some new and different stuff this time where we're going to have, not all of this stuff is confirmed yet, so I don't even want to say it, but anyway, we're working on some new and different stuff for this Meet the Masters event at the Hyatt Regency in Irvine. And a lot of you have been signing up. We've got the big conference center room with the big leather chairs and the stadium seating, and it's going to be just a phenomenal Meet the Masters event. So sign up for that at jasonhartman.com, and we will see you there. I'm going to keep this intro rather short because we've got 3 parts to this show today. First of all, you know I've talked to you before about St. Robert, Missouri. That is the special, unique, and you don't hear about it anywhere else because it's kind of one of these sort of undercover markets that we have done very well in. But Forbes magazine actually noticed St. Robert, and they did a survey of the fastest growing small towns in America. And guess what number 3 was? It was Fort Leonard Wood, Missouri, which is the greater St. Robert market. And listen to this. The 2010 population was 52,274 versus the 2007 population, 44,326. That is a growth rate in 3 short years, folks, of 17.9%. Don't fall off your chair. 17.9% in 3 years. That is a phenomenal rate of growth. And I hate to say it, or actually I love to say it. We told you so right here on the Creating Wealth Show. We've been profiling this phenomenal little town, Fort Leonard Wood, St. Robert, Missouri. Unbelievable opportunities. We have a great vendor there. I own property there, 10-unit apartment building with some clients of ours. If you've got anything you want to invest in there and you want a partner, I'm sure that I would be interested in investing with you. So bring it to me if you're interested, or do it on your own. Get in touch with your investment counselor. Go to jasonhartman.com, and do not forget about this under the radar, this below radar market. We've had some phenomenal experiences there, and I'm sure they will continue to be so. Take advantage of that and contact your investment counselor at my company through the jasonhartman.com website, or just go to the website direct, and we will be happy to help you with the 3rd fastest growing small town in America, according to Forbes. Forbes.com, Forbes magazine. Gosh, you know what? I got a whole bunch of stuff I want to cover with you, but I'm going to leave that for another show. I want to talk about this really interesting article that talks about taxation and revenue and how taxation and taxes are obsolete in an environment where you have a Federal Reserve Bank and a Treasury like we do. We'll get to that on a future show. I want to talk about, what's the title of this article I wanted to talk about here? Inside the Fed in 2006, banter about a coming crisis. One of our clients, Steven, sent that to me really interesting. Kyle sent me this great article I want to talk to you about, A New World of Cities, Redefining the Real Estate Investment Map, and 5 Global Investment Drivers. Really some interesting stuff there. But you know what? For once in my life, I admit that we don't have time. So let's get into the next 2 segments of today's show. Let's talk about this very unique financing for foreign nationals, self-directed IRA investors, and people with more than 10 properties, and people with maybe some slight issues in terms of credit. Again, this is not for a really bad credit type of loan. They do credit score this loan, but again, there is some flexibility at least, and we're not talking about strict underwriting guidelines here. So let's go to that. Let's talk about Meet the Masters, and be sure to register at jasonhartman.com and click on the events section. Join us at the end of March for Meet the Masters, Hyatt Regency Irvine. You're going to love this. The room block is, it actually did sell out, but I just emailed the hotel, the Hyatt Regency there, and they opened up a few more rooms in the block. And again, they've got that special $99 rate, so pretty phenomenal. So anyway, let's get right into it here. We will be back in less than 60 seconds here, and we will talk about this special financing, and then we'll play some clips from a prior Meet the Masters event that I think you'll enjoy. And a whole bunch of shows coming up, phenomenal shows coming up. We've already got the next 6 shows planned out: Creating Wealth number 242, 243, 244, 245, 246, and 247. We have some phenomenal guests that range from Ellen Brown, just a whole bunch of things in the pipe. So keep on listening, and here we go. Let's get into this show.
You know, Penny, sometimes I think of Jason Hartman as a walking encyclopedia on the subject of creating wealth.
Well, you're probably not far off from the truth, Rich. Jason actually has a 6-book set on creating wealth that comes with over 100 hours of the most comprehensive ideas on investing in business. They're in high-quality digital download audio format, ready for your car, iPod, or wherever you want to learn.
Yes, and by the way, he's recently added another book to the series that shows you investing the way it should be. This is a world where anything less than a 26% annual return is disappointing.
Jason actually shows us how we can be excited about these scary times and exploit the incredible opportunities this present economy has afforded us.
We can pick local markets that are untouched by the economic downturn, exploit packaged commodities investing, and achieve exceptional returns safely and securely.
I like how he teaches us how to protect the equity in your home before it disappears and how to outsource your debt obligations to the government.
He's recorded interviews with Harry Dent, Peter Schiff, Robert Kiyosaki, Pat Buchanan, Catherine Austin Fitz, Dr. Dennis Waitley, T. Harv Eker, and so many others who are experts on the economy, on real estate, and on creating wealth.
And the entire set of advanced strategies for wealth creation is being offered with a savings of $385.
Now, to get your Creating Wealth Encyclopedia series complete with over 100 hours of audio and 6 books, go to jasonhartman.com/store.
If you want to be able to sit back and collect checks every month, just like a banker, Jason's Creating Wealth Encyclopedia series is for you.
Hey, it's my pleasure to welcome Bob to the show. You're really going to want to hear what he has to say because this is pretty special. He came to us through our Dallas-Fort Worth market, and his bank is offering some pretty phenomenal financing for investors. Now, this is something that is really, really appealing for anybody who has more than 10 loans. You know how you've got this Fannie Mae loan limit where you can't get as many investment properties as you may want to purchase, or for foreign nationals. If you don't have established credit in the United States, this is a great opportunity for people who are investing with their self-directed IRA, as am I. This is a great opportunity as well. This is some of the best financing I have seen in years. Okay, so you're really going to want to perk up and hear what Bob has to say because this is nothing short of phenomenal, this opportunity. And I'll give you the highlights and then I'm going to talk to Bob about it. We're going to get some questions answered and go back and forth. But basically, you can buy properties for only, and again, you could have more than 10 loans, you could have a self-directed IRA, you could be a foreign national, and you can get in with only 30% down, which is unheard of for any of those three categories: foreign nationals, IRA buyers, or people with over 10 loans that can't get any more loans at all. And they can be amortized over 15 to 20 years, and the starting rate is very low. It is adjustable in the latter parts of the loan, but these adjustments are very conservative. So it's setting you up as a borrower for success. And I just think you'll really like what he has to say. This is an FDIC member bank in the Dallas-Fort Worth Metroplex, equal housing lender, and you can even do this, get this, on a cash-out refinance. So if you have purchased properties through our network in the Dallas-Fort Worth Metroplex, wow, you can do cash-out and buy more properties. So you could turn one property that you might own free and clear with all cash into 3 properties and still have some change left over. Bob, welcome. How are you?
Doing very well, thank you.
Good, good. Well, this program you're offering is nothing short of phenomenal. I haven't seen anything this good in years. When you do financing inside an IRA, if there's even a lender you can find that will do the loan, the financing stinks. And you know, for the people with more than 10 loans that can't get any more because of the Fannie Mae loan limits, or foreign buyers who are dying to buy up American real estate that is on sale right now. I mean, wow. And it's in a good market, too. I mean, Dallas is such an attractive market for investors. We've been doing business there for years now, and our clients love it. They're having great experiences. Tell us more about this program.
Well, Jason, this is just something we kind of fell into, frankly. We didn't know what we were getting into, but it's just been very well received, and we're very pleased about that. You summed it up pretty well. Basically, we're providing 70% financing for either purchase or cash-out refi in adjustable rates of 3.315 or 3.320. Or 5.520, I'm sorry.
Let me stop you for a minute. Let's explain what that means. So basically what happens here, and listeners know that I'm not a huge fan of adjustable rate loans, but this is basically commercial financing. It's for investors. This is not the normal residential financing. And on any commercial loan, you're going to have adjustments. You just can't do the 30-year fixed type thing that I love so much. But even with the adjustments, because they're really nice, and I'm going to kind of explain a little bit how adjustable rate loans work, and then let you explain the way your loan works specifically, Bob. On an adjustable rate loan, there are a few different criteria you want to know about. You want to know about the start rate. So what is the initial interest rate? On this loan, it's only 5.5%. Phenomenal. Then the second thing you want to know is about the adjustment caps. In other words, every time the loan adjusts, what is the maximum amount that adjustment can be? Because on adjustable rate loans, what got a lot of people into trouble with them is they took these very low artificial teaser rates on the loans, and then they got what we call payment shock. And payment shock happens when you have a huge swing and the investor or the homeowner, mostly it's in homeowner case in the past here in the financial crisis, they just weren't expecting it. And they were living on borrowed time. When that adjustment happened, reality sunk in and then they got themselves into trouble. So start rate, adjustment cap. You want to know about the lifetime cap. In other words, during the whole life of the loan, if you go for 15 years or 20 years, what is the maximum that rate could ever be? What is the highest it could ever be? And then you want to know about the margin. And the margin is tied to an index. So actually, that's one more thing you want to know about, the index, okay? So there are various economic indicators used by lenders as indexes. They might be the prime rate, they might be the 11th district cost of funds, or the LIBOR, and forgive me, Bob, you're going to have to tell me what that acronym means, but it's like the London Interbank, I can't even remember because I don't deal with adjustables too much, but there are many indexes. And the final rate that you as the borrower pay is a combination of the index plus the margin. So those are really the 5 things that you want to know about with an adjustable rate loan. And just to review before Bob explains his loan: start rate, payment caps, or adjustment caps, I should say, adjustment caps, index, margin, and lifetime cap. 5 things. And maybe there's just one more I'll throw in that isn't particular to adjustables. This applies to any loan. So really only 5 relating to adjustables. And that is the points or the fees to get the loan. So taking it from there, Bob, tell us what you meant there by those numbers you were giving out, the 3.35 or the 3.315, 3.320. Go ahead.
Sure, great, thanks. Let me start maybe, Jason, by saying for loans less than $100,000, we're confined to an amortization not to exceed 15 years. Greater than $100,000, we would offer a 20-year term. So the beginning would be in a 3.315, let's say for a loan less than $100,000, our initial rate would be 5.5%. That rate would be fixed for 3 years and then adjust to Wall Street Journal Prime plus 1%. The cap of the adjustment is 2%. So in the real world, a 3.315 fixed for 3, adjusting each 3, there would only be a total of 4 adjustments throughout the 15-year term. 3 times, well, it's fixed for the first 3 and then the remaining 12 years. So 2% at each adjustment, your real exposure is 13.5%.
Yeah, so let me just stop you on that one, okay? So what that is that's what's called the worst case scenario. So in other words, if the loan adjusts, say that index goes way up, and by the way, your index is the Wall Street Journal prime rate, and then the margin is 1%. So index plus margin determines what I'll call the true rate on the loan, but then the true rate is subject to the adjustment caps. So say, for example, the Wall Street Journal prime rate goes to, say it goes crazy, which this is not the environment we live in nowadays. We're not under the Jimmy Carter regime. But say, for example, it went to 10%, right? Just as a crazy example. And then the margin was 1%. That would mean that your real rate is 11%. But it can only adjust as much as those adjustment caps allow. So if you start off at 5.5, and what is it, 3 years later, you have the first adjustment?
That's correct.
Okay. So that would mean in 2015, sometime in 2015, you'd have your first adjustment, and the prime rate is 10%, the margin is 1%, it dictates 11% being the true rate, but the rate you pay is only 7.5%, right?
That's exactly right. Yeah, don't forget, there is a floor rate, though. It would never go below the initial rate of 5.5.
Yes. So see, we talked about lifetime caps and we talked about adjustment caps, but we should also talk about the floor rate. So if interest rates go down, it won't go below 5.5 ever, which is, for this kind of loan, for foreign nationals, self-directed IRA buyers, and people with over 10 loans, 5.5% is nothing short of phenomenal. I mean, that is a phenomenal deal, because these people, they can't even find financing in most markets for either of those 3 categories. One question for you, though, and this is an interesting, just an aside, like a study to understand what's going on here in terms of that payment floor. What is the Wall Street Journal prime rate today?
3.25%.
So everybody listening, take 3.25% and add 1% margin, and what do you get? You get 4.25%, and that would say that's your rate, index plus margin, but the floor rate is 5.5. So you don't get to go below 5.5. Okay, still a great deal. Tell us more.
All right. We'd offer, if somebody was a little still squeamish about the ARM or the adjustable rate mortgage, we'd offer fewer adjustments. And rather than 3.315, we could do this as 5.515. So fixed for 5 years, adjusting each 5 years in that same 15-year term that we're analyzing here.
Yeah, so you're only going to have 3 adjustments throughout the entire life of the loan every 5 years. Wow.
Right. The price of that option, however, is a little bit greater rate. Rather than 5.5%, our initial rate and our floor rate is 5.75. So we add 25 basis points for that interest rate exposure shield, if you will.
Okay, and just so you know, so 25 basis points equals 0.25%. The Wall Street people and the sophisticated type talk is basis points, which is just 100 basis points in 1%. So 25 basis points, 0.25%. So instead of 5.5 as your start rate, you pay 5.75 as your start rate. And probably, Bob, also that's your floor rate, I bet, too, right?
Yes, it is.
Okay, good. Still a great deal. So I guess the bank really views the longer adjustment term as being a little bit more risky for the bank because they charge a slight, ever so slight, it's small premium of 0.25% for that.
That's correct. And for what it's worth, I've been looking at several loans in right around the $100,000 volume. Frankly, the price is, or let's say the monthly installment to pay for these things, the difference in the $3,315 and the $5,515 is only about $20 a month. So, for monthly cash flow, it doesn't have a tremendous impact. Over the term of the loan, yes, arguably it will cost you more.
So $20 a month, that's about the price of lunch. So not bad at all, and a lot less than your monthly internet service fee for sure. So drop a movie channel on your cable TV and you'll pay for that. Now, are you guys selling these off, or these have just got to be portfolio loans? You're just carrying them, I bet, right?
Yeah, that's correct. We make these loans here. We service these loans here. We are a community bank, and that's our intent, is to provide a very high level of service at a reasonable cost, and so that's what we do.
Incredible. I mean, you can even do it on a cash-out refi. Gosh, when you said that, I got so excited because I know, Bob, there's a bunch of people listening who would love to turn one property into 3 properties, which is exactly what they can do with that cash-out refi. So tell us more. Now, you've got I just want to make sure everybody understands, you've got the 3.315 and the 5.515, and the 3.3 just relates to the adjustment periods, and the 5.5 just relates to the adjustment periods. You want to tell us more about that before progressing to the 20-year amortization schedule?
Well, you touched on origination fees and so forth. We do have an origination fee of 1% of the loan amount, or $1,000, whichever is greater. Let's face it, we got to pay for my time.
Yeah, so in other words, what that means, a lot of these properties are so low priced. If you buy a $60,000 property, you're still going to pay, or say it's a $60,000 loan amount, you're still going to pay a $1,000 minimum origination fee. But on the other hand, if you have a $120,000 loan amount, then you're going to pay 1% of the loan amount. Which, by the way, actually brings me to a question, and I'm sorry to get off track here, but what about duplexes, triplexes, fourplexes, even small apartment buildings or anything like that where the price might be higher?
Sure. I'd want to reserve, let's say, hard finance commitment until we could see about the property and the borrower and so forth. But we certainly would be available for multifamily, be it duplex or triplex or the smaller apartment complex and so forth. Sure, we can do that.
I just want to comment that I love talking to a guy like you, because the difference, folks, here is you're talking to a community bank, a real person who actually is making a thinking decision, okay? And they're doing it in a way that is prudent and smart, because they're lending their own money and they're not going to sell this loan off. This is how it was in the old days. This is how banking should be. Instead of selling it off in some pool of securitized debt on Wall Street, the biggest organized crime syndicate on the planet probably is Wall Street. Just my humble opinion. But this is the way banking should be done. This is the way it was done in the movie It's a Wonderful Life with Jimmy Stewart. And this is the way it was done in the savings and loan era before things got all, you know how they got. They got all, quote unquote, sophisticated, which means there was lots more room to rip everybody off. But go ahead.
All right. I'd want to, I guess, just almost up front exclude one side of a duplex. Let's go ahead and buy the whole thing if we're going to get into that.
Well, I agree with you, because you don't want to do condos. You don't want to do like attached product, really. You want to do where the person is fully in control of that property, right?
Yeah, absolutely. Just for the borrower's safety and frankly for ours too.
I agree.
Let me see. So we wanted to touch, again on a loan amount greater than $100,000 would have the option for a 20-year term. It's certainly not a requirement. The self-directed IRA borrower, for obvious reasons of building equity faster, may want a 15-year term or even a 10-year term. If you want 8 years and 4 months, I'll do it. It just whatever makes the cash flow work. We want to know that there's positive cash flow coming out of the thing, because I never want to look to the borrower to have to subsidize any of the principal and interest payments of these things. Beyond that, it's probably important to also note our bank does not and will not escrow taxes and insurance. This
so
is
no
commercial
loans. Yeah, they do them themselves.
Yeah, you're a big boy. You need to handle that. So as the investor, that will be your responsibility.
And that, that's no problem. I mean, a lot of people don't like impounds or escrow accounts anyway, so no problem there. So maximum term and the amortization, and by the way, just a definition here, amortization, the root of that is the Latin word amort, which means to kill the loan. So when Bob says the loan is fully amortized, that means you pay principal and interest every single month, and at the end of that term, that loan is completely paid off, as opposed to, in a lot of these private loans and special circumstance type situations, you have a balloon payment at the end of the loan. These are fully amortized, paid off in 15 or 20 years, as it were.
That's correct.
What else does someone need to know about this?
Well, application process is fairly simple. We have a personal financial statement form that acts as something of a commercial loan application, if you will. We prefer that, well, I shouldn't say prefer, most of our borrowers coming into this program have some corporate entity as their borrower, and then we certainly require a personal guarantee behind that corporate entity. The self-directed IRA, by definition, would be different. Those are specifically non-recourse loans, and so that's okay. But our personal financial statement form, or if you have one that's created that's current, we'd look at it. We'll need a signature to accomplish a legal status of an application. Normal financials, 2 years of personal tax returns. If the corporate entity is previously existing, we'd want tax returns from the corporate entity as well. Our foreign investors are a little different in that we still want the financial statement. We still want Australian tax return or wherever you happen to be from, just to see sort of what's going on. But we'd add a driver's license and a copy of a passport for additional identification.
Okay, and how long does the process take to close one of these loans?
Well, these days I can knock these things out in 2 or 3 weeks. Now, as volume increases, we're anticipating very likelihood of ramping up some staffing if necessary. So the program is so new. Again, we've just got our feet in the water. We'll just have to wait and see sort of how that goes. At the moment, 2 or 3 weeks, we're closing these things without much difficulty. Now, that's from the time that I have everything I need. Let's clarify that.
Right. But that's still faster than most lenders.
Yeah, we see documentation kind of trickle in, one piece at a time.
But, Bob, that's still faster than most lenders are going to do it. So I think everybody listening is glad to hear what you just said. What else should people know about this? I mean, this is it's a great program. I tell you, folks, jump on this thing. One thing I want people to keep in mind with the adjustable rate aspect, because, again, all my listeners know that I am a huge fan of the longest fixed rate mortgage you can possibly get, because I think my view of the future is there's going to be a lot of inflation. I think we're looking at an inflationary future. So just keep in mind here, the real rate of inflation, in my opinion today, is about 9.5%, 10% real inflation. Of course, the official stat is much lower than that. It's about 3%, I guess, something like that. But all you've got to do, say you have the worst case scenario, and so let's do this on the 5-year adjustment. So we're going to start at 5.75% today, and then in 5 years, and that is in 2017, in the worst case scenario, that loan is going to go to 7.75%. Right, Bob?
That's right.
And then in 2022, that loan's going to go to 9.75%, right?
Well, it could.
Well, in the worst case scenario, I'm talking worst case scenario here.
In worst case scenario.
Worst
That's
case
correct.
scenario. And then say it's a 15-year loan, the last adjustment that will ever happen, well, no, wait, you've paid it off. You only had 2 adjustments, really, on a 15-year.
That's right. Right. You're in and out.
Yeah, so when you pay that loan off in 2027, folks, do you realize how much the world is going to change and how worthless the dollar will probably become by 2027? Your rate is only going to be 9.75% worst case scenario. I bet any of you listening, you're going to get paid to borrow this money after inflation. Wow. And you don't even pay your own debts anyway. Your tenants do. You outsource them.
That's true. Very, very true from the cash flow thrown off of these things.
Well, if you believe in that future, folks, that means Bob here is giving away money for lower than the true inflation rate. So thank you. That's a really nice gift, Bob.
Sure.
I'm being kind of sarcastic with you here, okay?
Let's talk about markets that are available for just a minute. We are confined to, in loose Texan terms, to our part of the world, which would mean Dallas and Fort Worth, in and around Central Texas, and perhaps as far south as about Austin, Texas. Those are our principal markets, or principal markets of our bank, and so we do want to keep this thing local within reasonable geography of where we work and live and operate.
Yeah, but for practical purposes, for anybody listening, Dallas-Fort Worth market area, because that's where we have the good properties.
Yeah, I mean, I'd love to be in Atlanta or I don't know what these hot markets are.
We would love to have you in Atlanta, Phoenix, Indianapolis, St. Louis, and all kinds of other markets we do business in too, but you're not. So that's right. It's fine. We'll just do this here. The one thing we didn't talk about, and maybe we'll just close with this, is the issue of credit score. And nowadays, tens of millions of Americans, whether by accident or by choice, have lower credit scores. And when I say by choice, I mean some people have chosen to do strategic defaults on things and so forth. And their credit's a little beat up. Now, this is not a loan for people with bad credit per se, but there is a little bit more flexibility because you actually have a thinking person looking at this loan package. And what do you want to say about FICO score expectations, Bob?
Yeah, good, Jason. We'd like to see a 700 score. However, that said, depending on the circumstances of what's happened and reasoning why and so forth, we'll consider lower scores. I hesitate to say a minimum score. I don't want to get into that. But to your point, literally speaking, I'm underwriting these loans at my desk. We use the credit report and we use the credit score as an additional tool, but we're not a credit scoring bank, meaning, I think Fannie Mae, Freddie Mac these days is minimum 620 no matter what. Again, that's the credit score is just one more tool in the bag to evaluate whether we have a reasonable credit request or not.
And I just love how these loans are underwritten by an actual thinking person who is not following some crazy financial model that the rest of the banks follow. You're just going to really look at the package and give it some thought, and that's a great thing. Well, good stuff, Bob. Anything else you want people to know before we go? Yeah,
just let's touch right back on that. If there are credit issues, if there's derogatory information out there, with your application package, save us all some time and effort. Go ahead and provide a memo of explanation. Here's what happened and when, and Grandma died and we had to pay for the funeral, or whatever the details are. Go ahead and play all your cards. Let's not play any games. It's just don't want to hide behind details. Tell the truth, the whole truth, nothing but the truth, and then we'll deal with what we've got.
Good stuff. Makes a lot of sense. Well, hey, contact us through the website, jasonhartman.com. Just fill out the Contact Us request or talk to your investment counselor at my company if you have one, and they'll put you in touch with our Dallas local market specialist too. We can get you all the details. If you use the website, just tell us what it was about that you were interested in the financing I talked with Bob about on the show in the Dallas-Fort Worth metro area, and we'll get you right in touch and take advantage of these phenomenal loans. This is really an incredible opportunity. Thanks so much for joining us today, Bob. Appreciate it.
Thanks, Jason. Appreciate talking to you.
What's great about the shows you'll find on jasonhartman.com is that if you want to learn how to finance your next big real estate deal, there's a show for that. If you want to learn more about food storage and the best way to keep those onions from smelling up everything else, there's a show for that. If you honestly want to know more about business ethics, there's a show for that. And if you just want to get away from it all and need to know something about world travel, there's even a show for that. Yep, there's a show for just about anything. Only from jasonhartman.com, or type in Jason Hartman in the iTunes Store.
This is Jason Hartman, and I want to welcome you to the Masters Weekend, a gathering of experts. This is one of the most successful events that we do, and it's a rare event. We only do it twice a year, where we gather experts from all fields of expertise, from all different locations around the country, and I just wanted to share some snippets from a few of them here on this sort of Masters Weekend sampler. And by the way, this is not a big promotion. This is content, so you're going to hear some pretty good content here too. Have you ever really wanted to know the inside scoop on analyzing investments, whether you should make that go or no-go decision when looking at a property? We will talk about the power of analysis. Have you ever really wanted to know how your credit score works? And of course it's important, but what parts of it are more important than others? There's a lot of misinformation about this, and we at the Masters Weekend discuss a lot about credit restoration and credit enhancement. Have you ever really been curious about tax strategies of high-level CPAs and investors use? Have you ever wanted to get a CPA who charges $385 an hour in the room to answer all of your questions pertaining to just real estate and home business opportunities? Have you ever been interested in 1031 exchanges? You may have heard that word but not really understand in depth what it is or how it works. Do you know that you can exchange not only real estate but all sorts of other things on the 1031 Tax Deferred Exchange laws? Do you know that you can go ahead and defer and basically never pay tax until it's in your estate and then have that tax or that tax liability step up to market value so the government never gets paid? Pretty cool deal. Have you ever been interested in asset protection? Have you ever been sued? Have you ever been concerned about the government coming after you about some kind of fine or attacking your assets? That happens to a lot more people than you think, folks. I've read a lot of stories about that. Have you been concerned about legal liability? People get sued and they're not prepared. It's very important that you set things up in advance and protect yourself with proper legal structures. Have you ever thought about investing in mobile home parks or self-storage facilities? These are some of the best ROI opportunities in the real estate world, along with multifamily and single family, but they include some very special things that you have to be aware of. Have you ever been interested in investing in real estate with your IRA or 401k? Boy, there's some great opportunities there, especially with the new law changes in 2010. Have you ever been interested in really getting your properties organized so that your real estate portfolio is managed efficiently like it's a whole little business unto itself? Well, we will talk about that at the Masters Weekend. How about talking to local market specialists? Have you wanted to get all these people that we talk about on the show in one room, in one place, so you can talk to property managers, local market specialists, all kinds of different experts that fly out from all around the country to help you with all of these various disciplines when it comes to investing? How about organizing your real estate business? Well, I do a whole session on organizational tips. How about a client panel with real-world stories? We call this Tales from the Edge. They're not all good, they're not all positive, but they're all real, and you'll hear from real people about the challenges they faced and how they overcame them. How about the best practices in the mortgage side of the business? Have you ever wanted to make sure that you can qualify for more loans, that you can structure mortgages properly, that you use mortgages as an asset rather than as a liability when investing? There's a lot to this. How about the last part? Fighting the three major demons of investing and the three major demons of your financial life. Well, we've got it all at the Masters Weekend, a gathering of experts. Let's listen in to a little sampler here as to what it's all about. You'll hear from many of the different speakers. Here we go. If people are experiencing hardship, the sort of first level of understanding, and I've had people ask this question, is, look, if everybody's broke, how will they rent my house? Well, it's just a matter of where they are on the economic ladder. So if you were to talk with your tenants, I only have one property, a local property in Irvine that I manage myself, but all of my other properties I have managers all around the country. And I own properties in 11 states and 17 cities. And so I don't talk with my tenants. But if I did, and if I were to in the next few years, I bet I would hear something like this. The tenant would say something like, I used to live in such a nice big house. I used to have a 3,500 square foot house. And now I'm renting from you a 1,600 square foot house. The point is, there's always a renter. It's just, what was their former life? They're moving down. Their lifestyle is being diminished. And I think for tens of millions, if not hundreds of millions of people, probably, their lifestyle will be diminished. One of the things we've got to practice to make sure that doesn't happen to us is financial self-defense. Financial self-defense from government, from central banks, and from Wall Street, because those are the three biggest threats to our financial security, in my opinion.
The power of analysis.
An investment is when we, as taxpayers or individuals, decide to take our excess funds and put it into some type of a vehicle that hopefully is going to give us a return. Now, a lot of us have been looking at our 401ks, which you keep hearing the word is 201ks, which is rapidly going into a 101k, okay? So, but we're investing in maybe in a 401k or something to that effect. We invest in real estate and such. But the bottom line, when we talk about investments, we're talking about the fact that we're taking surplus funds and we're wanting them to grow. That's simply what a defined investment is. When you're analyzing a property, there's two ways of analyzing the before tax cash flow, and then what is my real estate taxable income. What is my real estate taxable income? So when we're looking at it from two perspectives. Because what you have to understand about investment properties, for those of you that may be new to investments, is that you do not get taxed on the before tax cash flow. You are going to be taxed on the net operating income until we dip. And we're going to talk about that in a second. If I have a cap rate, say, of 10%, and say the property is $200,000 and my NOI is $20,000, that'd be a 10% cap rate. How to make a cap rate make sense is if you stopped and thought that if I leave $200,000 in the bank, and at the end of the year, the bank gave me $20,000 worth of interest, my return would be 10%. Okay, so that's one way of looking at cap rates to see whether it makes sense. Now, the one thing I'd like to tell you, when you're looking at multiplier, the lower the multiplier, the better for the buyer of the property. When you're looking at cap rate, the higher the cap rate, the better for the buyer of the property.
Credit enhancement and restoration.
So obviously the credit score is extremely important because you have to look at this in the long term. A lot of people just want instant gratification. I want it right now. But if you're an investor like all of you are, you have to look at the long-term effects of a credit score and why it's so important. Past due notices destroy scores. Every time you're past due, forget about it. It's a big, huge chunk. It's usually 50 to 60 points hit on your credit score every time that you're late. Missed payments is another big one, and the amount of the missed payment. The higher the missed payment, the higher the impact on your score. The lower the missed payment, the lower it is on your score. Your second factor, revolving debt ratio. 30% of your score is based upon your credit cards. How do you use your credit cards? So one of the factors, and I talked about this on Jason's show, is you want to share the debt amongst many cards. Jason called it credit socialism. It may sound a little bit funny, but it is to an extent true. The reason why you want to do that, if you have 2 or 3 credit cards, for example, right? And your available amount of debt is $100,000, and you ride it, let's say that 2 of your cards are at zero balance, but yet you maxed out on 1 card. It makes you look like you're maxing out all of your debt. So what you want to do is you want to spread it along those 3 cards so it doesn't make it look like you're just maxing yourself out on one individual credit card. Get added as an authorized user. What does that mean? It basically means if I'm Danny and I have Sue, and Sue has never had any credit in her life, because by the way, having no credit is as bad as having bad credit. Okay, that's why it's important to start somewhere. If Sue says, you know, Danny, I don't have any credit, but she is my sister, okay, and Sue comes to me and says, Danny, you know what, I want to establish my credit. What's the best way to do it? Well, Sue can join me as an authorized user. What does that mean? It means that she's on my account. Her number is being reported to the bureaus. So she's basically on my account, and she's utilizing my good behavior to show up on her credit report. So that's actually helping Sue gain some credit.
Tax secrets of wealthy real estate investors.
Okay, just a real basic tax law overview. Tax returns are based on tax law. A lot of people just don't think about that. They think, well, I just put the numbers in TurboTax and I get a tax return. But it's based on tax law. Tax law is created by Congress and written into the Internal Revenue Code. Then the IRS says we're going to make it more simple, and we're going to take these 2 volumes of the Internal Revenue Code and they turn it into 6. I don't know how that's more simple, but that's how they work. And I like this little quote from George Bush, stated that there are more than 1 million words in the Internal Revenue Code. Well, there's a lot more than that. But so we have the Internal Revenue Code. The wealthy individuals hire top CPAs and attorneys so that they can take advantage of tax law or tax loopholes. And we're going to go over a couple of those real estate loopholes today. All right, real estate benefits, just a recap. One, which has nothing to do with taxation, is ability to create passive income. That's why people typically want to invest in real estate, create passive income. How much money can I make cash flow positive each month? Ability to have renters pay your mortgage. Ability to reduce income tax. I'm going to focus on that today. That's why I have it in red. Ability to defer investment gain. There's a lady in here that just came up to me and introduced herself and said that she does 1031 exchanges. Has anyone done a 1031 exchange? Okay, a couple. All right. So a 1031 exchange allows you to swap one property for another one, and assuming that you have a gain in there, you don't have to recognize it. So as a recap, real estate professionals have the ability to convert passive losses into non-passive losses.
The power of exchange and deferring taxes.
Under present law, you can sell and exchange over and over again, going up in value, diversifying, buying multiple investment properties all over the country. You can do this over and over and over again. And under present law, if you pass away, your heirs receive the property at the step-up in basis or its fair market value as of the date of your death. And if your heirs sell that property at that value, at your date of death, they don't have to pay any of the tax that you've deferred over all these years of investing. Okay? It's a huge benefit. Every time you sell investment property, and all of you in this room appears to me have investment property. I'm very pleased to see so many of you own already investment property. But when you sell it, on page 30 is an example of a property where you have a choice. Once you sell it, you can sell it and pay the tax, or you can do a 1031 tax deferred exchange. And this is a good example of how you calculate that. We have a website. You can go on that website, put your own information, put your own depreciation, put any of your capital improvements, put the variables on that particular sheet into our spreadsheet, and it will calculate exactly what your taxable event will be. Taxpayers' intent to hold the property for investment is really the key. You must have a paper trail showing that you've held the property for investment on Schedule E of your tax return, because everything is tracked through your tax return. So make sure that you get it on your tax return. It does not have to have income, however. You could have raw land and you could have expenses but no income. That would still be considered investment property. And again, foreign real property is not like kind to U.S. real property.
Asset protection secrets.
However, if you do have a good asset protection plan in place, you will discourage people from suing you just because they think they can get to your money, because when they do their asset search, there it shows you with your millions of dollars or hundreds of thousands of dollars of assets. If we do it right, they're going to do an asset search on you and they're not going to see much. Unfortunately, it's also not going to make your life any simpler, but it's not going to make it overly complex as well. A lot of it really depends on the type of asset protection you need. Think of it this way. You've got your assets in the middle, and I like to think of it as a trilogy. You've got risk management, which is one circle, one barrier around your assets. That's the common sense stuff. Don't drive 120 miles an hour on the freeway, obey the laws, etc. You also have insurance. Insurance is something that we have to have or should have depending on where your exposure is. If you have your own business, then you're going to have a lot more insurance than if you're just a non-business person and you're just running personal risk. You would have your normal, maybe an umbrella policy or something to that effect. Here's the problem with the international entities. After 9/11, anytime money's going in and out of the country, there's a lot more scrutiny to things. As long as you're not using it to evade taxes, you'll be okay. You can do these international entities, but it also limits what you can do. So if you have an international entity that's then coming into the U.S. and buying something, well, you're not going to be able to do an S-Corp. You're not going to have the tax pass-through. It complicates things. And so maybe you do a trust.
Mobile home parks and self-storage facilities.
But this is what's going to set you free. This is what is just a huge juggernaut. Because for every home that we have coming into our park, that the space is free, we're not getting any rent whatsoever on that space currently. When we bring a mobile home in, that space all of a sudden, say we have $200 lot rent, we start getting $200 a month on lot rent for that space where we got nothing before. It was just dusty old dirt. If you annualize, that's $2,400, and you put a 10 cap, that's $24,000 a month, or $24,000 equity we have in that home. If we bring in 10 homes in 1 year, which is not a whole lot of homes. We usually bring in about 20 to 30 and some even 40 in some of our parks. But if we bring in 10, that's $250,000 that we just went up in our equity. That's also, with it is that's $24,000 of income that we didn't have today. A $10 monthly lot rent increase adds $1,200 to your bottom line. What happens with mobile home parks is it's very difficult, at least up until about a year ago, for people to move their mobile home into your mobile home park because it costs roughly between $3,000 and $6,000 to move a mobile home, whether it's a single wide or double wide. So what would happen is you buy a mobile home park at 50% occupancy, you need to bring that mobile home in because nobody else is going to bring it in unless you do. So we were buying a lot of mobile homes from the banks. And we were moving them in, we're setting them up, and then we're renting them on a lease option program with the tenant.
A client panel where you'll hear real stories from real clients, and it's not all good, some hardships and how they've been overcome.
Mike had called me and said, hey, we got this model home. I need an answer in 2 hours. So I had to make this decision. We bought a model home. The builder rented the model home back from us. So the good thing about that was the rent was like $350 more than what you would usually rent, and they paid the property taxes. So we bought that from Mike. And then we're going to see Mike at the end of the month. We're going to fly down and see Mike. He's going to pick us up at the airport, give us the 2-bit tour of Austin again, stay at his house, take us back to the airport the next day. So you need to build a relationship with your realtor or management company wherever you go to. Good story was I have the model home because that brought in a bunch of income.
Certainly in terms of the overall buying experience and a group that's focused on education more than just selling properties, Platinum was the best buying experience. My wife and I started buying in 2002, and like Jason said, we've bought through Platinum, other real estate networks, and some totally on our own. So that was the easiest in terms of the buying experience.
Yeah, I did a little bit of research, and I knew the areas I wanted to buy, and I went to a couple of investment groups. This is the only one that actually agreed with where I wanted to invest in. So Texas was the first place I wanted. I bought in Round Rock. It took me 3 weeks to get it rented out. I'm very happy with it. The tenant was there for about 15 months. They ended up leaving, just took off. We ended up re-renting it within 3 weeks as well. So actually the first time it was 3 days, and then it was 3 weeks afterwards.
And actually, again, those properties I did see, I saw 3 of my Texas properties, all very great communities. One of my friends that's actually a property manager in Dallas went with me to a Dallas property, and she just said, heads up that this was just great construction, great community. And so where I've really felt very grateful and confident is that generally speaking, everything that I've purchased into has done very well.
And so I went to your website, listened to all your podcasts, sent in a letter. And I think I came here that week before I even went to one of your seminars. I sat at his desk and I took home 3 properties. And
you took them home?
I only bought 2. Well, I took home the formats, whatever you call it, and I ended up buying 2 that right at the very beginning.
So anyway, what I wanted to talk about was the 4th one on there, the maintenance and manager and monitoring. My husband and I were new to this. We had never owned rental property. We had owned homes. That, we had our first house, and we waited for the equity to build, and then we went and got the house we really wanted. But we never were property managers or landlords. And so in the seminar that we had attended, one of the things that stuck in our head was, even though you guys are scouting out this property for us and that you pre-screen these property managers, you still have to do your own homework, and you still have to be responsible ultimately for your property.
One is in Pflugerville, in Texas.
That's the Austin area.
That was the first one I got through Platinum. That's great. It was a new build, $170,000, and it's needed no maintenance at all. The tenant's been in since day one. Took 3 weeks to get a tenant firstly, and that's just on a year-to-year basis for lease.
I got the property rented within 3 or 4 weeks. After the rehab, I've never been there. I probably am a little delusional when I look at it. I write a check for $510 with my taxes and everything, and I get that check for around $900. So it seems good to me. But so far, it's been a good experience. We have an offer in for another one, and I would recommend everybody listen to all the podcasts because it's just free information. I've had rental properties before, which I sold and had to pay capital gains. So there's a lot of free information to learn. And you don't charge for that, which I think is a great service. So I've enjoyed the experience. It is a little scary because everybody says, why aren't you going to go there and look at it? I go, I got to trust somebody. And actually, the house I bought in California was more work than this one. I just wrote a few checks and made a few phone calls and didn't really have to. It was less work.
Investing in real estate with your IRA.
So how it works is you really want to think about your IRA as being in an umbrella. So if you can forgive my drawing and pretend that looks like an umbrella. Normally, if you have an account at one of those custodians that I was just mentioning, you can invest in things like CDs, right? What else? Stocks, exactly. Mutual funds, bonds, things like that. So with a true self-directed IRA, whether that's with Intrust or another truly self-directed custodian, you can expand that. We would never tell you not to invest in this list because we want you to be truly diversified. But you can invest in other things like real estate. So that could be, a condo, a single-family home, a fourplex. It could be foreclosures. It can be raw land. It can be tax liens, LLCs. You can invest in anything except for a life insurance or a collectible. And we'll talk a little bit more about what a collectible is in a few minutes. So along this lines with the IRA, if you have a traditional or a SEP or a simple IRA, so anything except a Roth, all of your funds are going into your IRA on a pre-taxed basis, right? All the funds are going in on a pre-tax basis. And along those same lines, all of your profit and gains, such as rental income if it's a piece of real estate, is going back into the IRA. So this is all the profit and the gains going into the IRA.
My organizational tips.
In addition to that, you do need Quicken or QuickBooks probably. Have 2 files, have a 2-filing system. And I just developed this with my operations manager. First, you have your acquisition file. This is legal size. Then you have an operations file. It's letter size. But in here, you have a system. And here you have a description of the house, sales brochure, plot plans, photos. Of course, you have your photos electronically, of course, as well. Purchase contract and your final HUD-1 statement. Your HUD-1 statement is your closing statement. Insurance information, copy of your home warranty, your first loan package. Okay, so that's for your loan when you use it to purchase the property, the purchase money loan. Appraisal report, second loan package if you have a second. And here you have your mortgage loan disclosure statement. And then here, we just provide like a little glossary of terms. We have this filing system. Here's a couple cautionary things. This doesn't happen as much since the credit meltdown. But loans used to just get transferred all around. Now none of the banks trust each other. Why should they? They're all a bunch of crooks. Okay, none of these Wall Street firms. So you don't see the loan transfers happening quite so much anymore. But remember when a couple years ago, you'd get a loan with one firm, and then it'd be transferred again, and then it'd be transferred again, and then transferred again. And it's like every 3 months you're making your payments to a new entity. I mean, that was a hassle. And it was easy to miss a payment or get confused, okay? That's not such a problem anymore. One good thing about the credit meltdown, okay? In fact, it's so disorganized right now, they might just forget you owe the money entirely, okay? It's amazing. Flood insurance and land surveys. So sometimes they'll reclassify a property and say it's in a flood zone. It's not, and that's not too common, but it's just something to be cautious of.
Fighting the 2 major demons of investment, the demon of risk and the demon of inflation.
And this is kind of where I get into what I call the post-responsibility era. Now, I didn't want to put this in because, and Jason said, well, no, Doug, you need to include something about all these bailouts, okay? Because you could take as much risk as you want now and someone's going to bail you out. And I'm like, that just feels wrong to me because, to me, I've always thought that if you take risks and you're an idiot, then if you too much risks, you lose all your money. If you tell people, well, we're going to bail you out, we're going to bail out people who act like idiots, all you're going to get is more idiocy, which is true, but if the government's bailing people out, if they're throwing $100 bills in front of your feet, you'd be kind of dumb to not pick it up. And so in the post-responsibility era, there are opportunities where even if you have taken risks that have turned out badly, there are chances to not be totally wiped out. Am I saying you should depend on that? No. Am I saying you should be aware of it? Absolutely. I'm just going to go through really, really simple illustration of what causes inflation. Prices, first of all, are an equilibrium between the amount of money in circulation in the economy and the amount of goods and services that are produced. And if the amount of money increases and the goods and services stay the same, the prices have to go up. If you just kind of think about it as two bubbles, right? One bubble is your money and another bubble is your goods and services. If the goods and services go down and the money stays the same, the prices have to decrease. If the money goes up and the goods and services stay the same, the prices have to increase. Now, you'll always have things trading off. Commodities go up and down, and if we spend more money for, say, soybeans or oil, that means there's less to spend on something else. And then when there's that lower demand, then the prices will adjust downward. But the only thing that can drive all the prices up at once or all the prices down at once is the supply of money.
Property analysis, market analysis, and property tracking.
So real estate is a numbers game, and to be successful, you really do have to understand the numbers. And our goal is to make this as easy as possible. So we've combined 8 tools into one package where you can research the different areas. Jason showed the appreciation map earlier. You can purchase a property by shopping around for the properties through Jason's website. Track the income and expenses on the property. Do online tax preparation, online loan applications. We have an online document storage system so you can keep an off-site backup of all of your important documents as PDF files. And then we have calendars, contacts, and a correspondence log, and a bunch of other miscellaneous little utilities. So those are the basic 3 steps, and now we can look at the report. You can look at maps, satellite photos, and you can upload your own picture of the property or get it from the real estate agent. Most of the ones on Jason's website have the picture there, so when you add it to your portfolio, it'll automatically show up. And then finally, you can look at a brief summary report, which does the apples-to-apples summary comparison between the different properties. So let's say I was thinking about buying these 3 properties. I could just click on this brief summary, and it shows me the basic numbers right on the same page. So I'd look at these, and I'd say, okay, that one's minus 3% cash on cash, 82% ROI. This one's minus 55% and 53%. Okay, that one's out. And then this one's minus 1% and 44%. Okay, so based on these 3, I'd eliminate these 2 and I'd say that's the best deal. So it really takes the guesswork out of finding out which property is truly the best deal.
Best practices in management.
All right, Owner 101, things you should do, things that we expect of you. You should pay your own mortgage. Be actively involved in your property, people. One, you have to kind of say you are to get the tax benefits for being an active owner. So pay your own mortgage. Don't rely on your mortgage or a property manager to pay your mortgage. Don't give the control of your property to someone else, no matter what, even a good guy like myself. Your property manager needs to have plans for you. You have to know what those plans are if you want to know what they are. You need to know how your property manager is securing your information because it needs to be secure. You don't want that information floating around. I always notify my owners of their tenant qualifications. I let the owner be involved in that process. It's your property. Why in the world would you let anyone just carte blanche move anyone they want to into your property? Why would you do that? Some property managers don't give you that option. Their management contract specifically says, I have the right to move anyone into your property that I deem fit. And if that's the way they do business, that's the way they do business. But you shouldn't have to do that if you don't want to. Don't be afraid to ask questions. And that's the key. If you don't understand something on your statement, if you have a problem with something that happened on your property, the yard wasn't being mowed and you got an HOA violation sent to you, ask questions. Be involved. Don't be afraid to put your property manager under the fire. Do not feel rushed to take a bad tenant. You're sitting here, you've had the 8-month vacancy, and it hurts. And you get a tenant that is not so great, but you want to take that chance because you could really use the mortgage being paid. If you take a bad tenant, it could work out for you. However, if you take a bad tenant, you could end up in a worse situation than you are now.
You'll learn about mortgage planning.
let me ask you this. If I asked you to make a list of assets on a sheet of paper, I can use this drawing board here, the typical financial advisor is going to be working with some of your assets, typically your stocks, your bonds, and your mutual funds. Does that make sense? However, if I asked you guys to make a list of all your assets and real estate was on that list, wouldn't that real estate be your single biggest asset in your list of assets? Wouldn't it be? Absolutely, right. And on the liability side, if you have a mortgage or mortgages, wouldn't that be your single biggest liability? We hope so, right? If it's not your single biggest liability, we got bigger problems, right? So, in addition to that, this mortgage, if you have a mortgage, is also likely to be your single biggest monthly expense. So the typical financial advisor, again, is only dealing with part of your assets, your stocks, bonds, and mutual funds. Yet, your single biggest asset, your single biggest liability, and your single biggest monthly expense, and I wish our guy from Merrill Lynch, is that where he's from? Or used to be? The expatriate? David, yeah, I wish he was still here because he'd agree with me. Single biggest asset, single biggest liability, single biggest monthly expense, and unfortunately the traditional financial services industry gives lip service at best to helping you manage these very significant numbers. As a financial advisor, a lot of times people come to me and say, Randy, what can you really do to help me manage my mortgages, manage my debt, manage the equity in the real estate?
Market profiles of several markets from around the country.
All right, so the Atlanta, we call it the perfect storm. Again, we didn't research where we started investing. It's just where we lived, and so we started just investing in real estate there. And so we would like to say that we researched and made great decisions because we like the economy and what's going on there. It just happened that way. But there's a lot of documentation. I have it all in my folders, which will be back there, from CNN.com to Forbes to the Fortune 500 publications of why Atlanta is an incredible market in terms of owning an investment property. First of all, affordable homes. The affordability of houses and quality houses in Atlanta compared to what's obviously going on in other places, and especially here, it's not comparable. The value and the type of nice property that you can get for a low dollar amount is unmatched. The large rental market, huge growth of transplants, business transplants that come into the city. Atlanta doesn't have Hollywood, it doesn't have the ocean. What else are the draws here? In-N-Out Burger. We don't have the stuff that draws people that want to live there. Why people come to Atlanta? Corporate business climates. The growth is consistent and steady. The job diversity, the economic growth in Atlanta is huge, and it has been for a while. The growth charts are consistent and they're continual. The young professional population is huge. The educational economic atmosphere. There are in the downtown Atlanta area, which you can see here, there are 13 universities. And so 4 of them are on 6 city blocks right next to each other. Then you got Georgia State, you got Georgia Tech, you got Emory. There's 13 universities. So the young professionals that come out, obviously that are going to be renters initially, the transplants that have to go there and rent houses, the rental market, and not even including the main factor, of course, which is people that can't get loans right now. It is an incredible place to own a rental property right now.
Now you can get Jason's Creating Wealth in Today's Economy home study course. All the knowledge and education revealed in a 9-hour day of the Creating Wealth Bootcamp, created in a home study course for you to dive into at your convenience. For more details, go to jasonhartman.com. This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.